So we're gonna have Michele Andreolli, who's a visiting assistant professor at Boston College.
Yeah.
And it's going to talk about monetary policy and the maturity structure of public debt.
Okay, well, thank you everybody for coming to this session and for the organized put the paper on. Can I have to put it in full screen? Full screen? Yes. And this paper is just what the title says, just ask whether the maturity structure of public debt matters for the transmission of monetary policy. In the next 15 minutes, I'm going to try to argue that it does. Now, if you start thinking about the two concepts, the maturity structure of public debt and monetary policy, it is clear that they should be strongly interlinked. On one hand, and I don't need to say to this audience that public debt matters, and because it's such a large asset class, the central bank should look at it for the conduct of monetary policy, but also the opposite is true. The maturity structure of public debt, but really of any debt, says how much this debt is sensitive to changes in interest rate. And because monetary policy is one of the biggest source of variation of changes in interest, it is clear that the concept should be strongly interlinked. However, where it's clear they should be interlinked, it's not exactly clear the direction in which the interaction would go. Would the monetary policy will be stronger in reducing output when public debt is longer or shorter maturity? If you start thinking about the perspective of bond investor, and so valuation effect, you might expect stronger effect of monetary policy when the maturity structure of debt is longer. The longer the maturity, for a given change in interest rate, the market value of that will fall more. So you might expect stronger effect. If you take the perspective of the government and rollover risk, then you might expect the opposite. Because if the government has borrowed with long and fixed rate debt, interest increase, they are insured against that. So you might expect weaker effect of monetary policy in reducing economic activity. In this paper, I'm just going to try to answer that and to try to put a direction. How do I do that? I proceed in several steps. The first step is I propose a new metric to study the insurance properties that long debt has for the fiscal authority. Next, I test the conditional effect of the maturity structure of public debt on the transmission of monetary policy, where I use US and UK data to study them. In order to be able to simple regression, I provide a new narrative identification of the maturity choices of the US government. Specifically, I argue that a law made it impossible for the US Treasury to coordinate with the Fed. So even if they wanted to coordinate, they couldn't, meaning that you can run a simple interaction regression and achieve identification. In the next part of the paper, which I will just touch upon today, I bring a model to rationalize the empirical result and the channel and to do counterfactual analysis. This model is a financial accelerator model where I add the primary market friction, where this friction is microfounded and estimated with high frequency identification. Now, this is what I do. What do I find? The main result is that long debt attenuates the effect of monetary policy on economic activity. On average, of a 1% exogenous increase in interest rate, output falls to 1%. When public debt is very short, the same 1% increase in interest rate lowers output by about 2%, so stronger effect when debt is short. We see a differential effect on output, but we don't see a differential effect on inflation. This means that it does not matter whether public debt is long or short, interest increase lowers inflation always by the same amount. Why is this? I argue it's because of a financing channel. So let me make a very simple example. Either the government borrowed all of its debt with short or with long and fixed rate. And we have a 1% increase in interest rate in both cases. If the government borrows short, they need to refinance everything at a higher rate. If they borrow long and fixed rate, they don't because they locked in a rate. So the government, if you move from short to long, they have a relative windfall after an interest increase. What I show is that when the government has a windfall, then in the future, they just borrow less. And then when the government borrows less, the non-financial corporate, they borrow more at a cheaper cost, and they invest more. With an idea that there is a direct crowding out effect in debt markets. I can replicate this empirical result with a model with a small friction on primary markets. And the reason is because there's a strong complementarity between primary market friction and the financial accelerator, the friction on the first side. In a counterfactual analysis, I show that maturity is really key. Small changes in maturity in the model have very big effect on the effectiveness of monetary policy on output, whereas debt levels are very secondary. Meaning, if you have more debt, sure you need to refinance more, but this level is much more secondary, and so it doesn't really matter quantitatively. And this brings me to the policy and the academic conclusion. The policy conclusion is that increasing interest rate now during the current tightening cycle is not to be as costly to fight inflation because most governments have lengthened the maturity of their public debt in the low inflation period before the COVID period. And so maybe this is one reason why we didn't see a fiscal crisis in most advanced economies with the current tightening cycle, where it's increasing interest rate by quite a bit. On the academic side, I argue segmentation in asset market is not only important to understand asset prices or debt prices, but also is important to understand the transmission of monetary policy to economic activity. Now, let me jump directly into the meat of the paper. And the first thing I do is propose a symmetric duration GDP. I argue this is particularly helpful metric to understand for the debt management offices and for practitioners for central banks. So I would like to spend a second to discuss what this is. This is, the definition is, tells you how much does the market value of public debt falls in GDP unit following a 1% increase in interest rate. And so this is a market value concept. What I prove in the context of the model is that if the change in interest rate is permanent, this also measures the present value of the lower debt servicing cost saving that we have with existing maturity compared with overnight debt. What does this mean? If I have short rate debt and interest rate increase, I need to refinance everything. If I have long fixed rate debt and interest rate increase, I need to refinance a little less. How much less? Duration to GDP. So this is how much less the government will need to increase taxes following change in interest rate. And the nice thing about this metric is it's very easy to compute from bond data and to just GDP information. So this is quite easy and intuitive to compute. How does it look for the case of the US? Here I'm showing in red the traditional macro duration of US debt in years, and in blue this new duration to GDP metric. What we can see here in percentage points of GDP are that in the US there has been long regimes for duration to GDP, was low in the 70s and 80s, became high in the 90s, was low in the 2000s, and got high after the financial crisis. And this is a very slow moving object. Moreover, if we compare the correlation of this metric with the same, but for the UK, it's negative. Meaning when public debt is long maturing in the US, it is short maturing in the UK, and vice versa, which is important to get external validity of my results. What do I do with this metric? I plug this in a local projection. There's local projection are very common in this type of literature. What are the local projections? What are the key coefficients that I care about? We have some outcome variable, output, investment, inflation, I care about, and we have two key coefficients of interest. And this has been here is not a minus on my part. Beta 1 is the effect of an identified monetary policy shock, and level effect, and beta 2 is the interaction coefficient between an identified monetary policy shock and duration to GDP. This says what is the effect of a 1% increase in interest rate when duration to GDP is 1 standard deviation high. So this is the differential effect of monetary policy when that is longer mature. We can see the flip side of that, or the level effect, by looking at beta 1. This is the effect of a 1% increase in interest rate when public debt is very short, is counterfactually overnight. In terms of the identification of monetary policy, I don't innovate. I show you today a result for narrative. They work with high frequency and recursive. Where I innovate is in the narrative account of the maturity process. I exploit a gradual repeal of a law that was in 1918 in the US that basically made it impossible for the Fed and the Treasury to coordinate in the pre-QE period, meaning we can run this regression and achieve identification. What do I find? This is the key empirical results of the paper. I'm showing the effect of a 1% increase in interest rate on industrial production on the first row and the price level on the second. Now, let me walk you through this graph. In the first column, I am showing the average effect. Without any interaction, this is the result from a handbook chapter by Rand. 1% increase in interest rate, output falls about 1% after 1 year. 1% increase in interest rate, the price level falls about 1.4% after 4 years. These are quite standard effect of monetary policy. Now, what about the interaction coefficient? And my interaction regression is shown in the other two columns. I'm showing you the interaction, beta 2H. So, which is interaction between a shock and duration to GDP. And this is the key result of the paper. The interaction on industrial production is positive, statistically significant, and large. This says if interest increased by 1% and debt to GDP and duration to GDP is 1 standard deviation higher, monetary policy will be 2%. How do we interpret the magnitude of this coefficient? Well, we can just look at the level under the effect under short end. If that was very short, overnight, the same 1% increase in interest rate would lower out by about 2% rather than 1%. So long debt attenuates the effect of monetary policy on economic activity. Do we see a similar mediating effect on inflation? No. The coefficient is always around 0 and is never statistically different from 0. So the effect of monetary policy on the price level is the same irrespective of the average or under short term. This result, this was my market paper, you can imagine from the number of robustness check, works in the UK, works in the US, is very robust. Why do we see that? The argument is this financing channel. And let's go back to the simple example. Is there all that is short or all that is long and fixed rate? And we have a 1% increase in interest rate. We move from short debt to long debt. The government is insured, and so they have a relative windfall compared to the short debt case. What does this mean? Well, by the budget constraint of the government, it means that we must see either a reduction in borrowing, they say the windfall, or an increase in primary deficit, the spends. And we must see one or the two. I'm checking the data, and I see a strong reduction in borrowing, but no increase in the primary deficit. And this is the idea that maturity affects how much financing the government will do. That's why I call this the financing channel. With these arrows, I'm showing beta 2 coefficient, the one from the impulse response function. I don't have time to show you the actual impulse response function, but believe me, government borrowing declines if debt was longer maturity after an increase in interest. Now, why does this matter? Because at the same time, non-financial corporate, they issue more debt at a lower cost. And this is the idea that there's a direct crowding out effect in that market. Government borrows less, they can borrow more at a cheaper cost. This matters for the macroeconomy because at the same time, they also invest more with lower leverage. And this is why we see the relatively higher up. Now, in the last couple of minutes that I have, I'm just going to give you an overview of the model to rationalize this fact and to do counterfactual analysis. This is Bernard, Gerten, and Gilchrist, meaning new Keynesian model with a financial accelerator, where I clearly add long maturity fixed rate public debt. And the next ingredient is a financial friction on primary market debt, where the layman idea is that there's congestion effects. If the government borrows more, it makes it more expensive for itself to borrow, but also for the non-financial corporate. And I profound this friction, and I propose an identification to show it to show this in the data. What do I find? The model gives me 4 results. The first result is that I can prove in closed form the equivalence of duration to GDP, meaning it measures a market value object, but you can show that this is also the debt servicing cost savings, which is what the fiscal authority or the DMO should care about. Also, I get that with low maturity public debt, 1% increase in interest rate will lower the output by more. And this is achieved with a small friction on primary market because of a strong complementarity between the friction on the primary market and the financing condition on dominant financial firms, the financial accelerator. Finally, I guess I am almost out of time, but let me tell you about the counterfactual analysis. What I show is that if we fix the level of debt and if we lower maturity, we see much stronger effect of monetary policy on economic activity. We can ask ourselves something which is the opposite. Let's fix maturity at historical average and let's increase the amount of public debt. Why? Because with more debt, I need to refinance more. I can get a same level of amplification, but at the cost of having a way higher public debt. I need to go from 0 to 700 percentage points of GDP to get the same magnitude. Clearly, if public debt was at 700 percentage points of GDP, maybe default risk could be a bit higher, but this is to really to say that to understand the financing channel, maturity is a first order phenomenon, and that level is second order. And with this, I can conclude. In this paper, I argue that the maturity structure of public debt matters for the transmission of monetary policy. Central banks should look into that. What do we show? Long debt attenuates the effect of monetary policy on economic activity, but we don't see the effect on an inflation effect on the price level. And why do I argue that we see this? Because of a strong crowding out in the markets, and this is the so-called financing channel. I can rationalize this result with a small friction on the primary market because of complementarity, and argue maturity is really. And this brings me to conclude to the policy implication. We have seen a huge increase in interest rate now, and we've seen a huge increase in interest rate where most governments, especially in the advanced economy, had a very high level of public debt historically. You might have expected that we would have had a fiscal crisis like the Euro sovereign crisis by now with this very high level of debt and this increases in interest rate. We didn't see that because one of the reasons we didn't see that is because most governments lengthened substantially the maturity structure of the public debt when inflation was low. This means that they were insulated against the rate hike, and so it made it relatively less costly on output to increase the interest rate to fight inflation. And I guess I'm done.
Yeah.
Thank you.
We can see the preparation for the job market. They can present with any given time given to them. They will make. Questions.
7 minutes.
That was
Questions? Yeah. In the back.
Yeah. What I understand is the focus has been on the stock of the debt, when you're thinking about the duration and maturity. Have you really looked at how the actual flow of short-term versus long-term debt affects the way you're looking at it?
So I test whether the flow of new debt is changing depending on the stock of previous debt.
Sorry, what I meant was, just to clarify, for example, if you're taking let's say in this particular year, the stock of short-term debt coming due versus the stock of long-term debt coming due, is that something you have to look at?
Not the ones coming due. It's just the existing stock of debt, whether it's long versus short. But clearly, if you have more short-term debt, you will have more debt coming due. A nice thing about the US debt is that you can quite well approximate the debt profile of the US debt with a geometric decline of the principal payments. And this does a 90% R square on explaining that. So you can really think that 10% of your debt is, one of your maturity of your debt is coming due every year, and this is a very good approximation of how much that the government will owe.
Yeah.
I really like the maturity versus debt, but we don't check debt service.
Debt servicing.
Really, that's what it meant for the market sector, other than maturity structure or in debt stock, maybe debt service.
Yes, the nice thing about maturity is very slow moving, and then this gives you basically how much debt servicing you are due. And because of this nice feature of the US debt that you can really approximate how much debt you have, which you will owe, which is one of the maturity, they are basically interchanged. But I agree, conceptually, it's how much debt is coming due that matters. But because of this feature, you can basically look at one or the other.
So first, very nice paper. I like the way you motivated the paper by having these two effects, the one on the government side, so to speak, and the one on the investor side. And I didn't see much on the investor side on your slide. So maybe that's too much asking for one paper, but I was wondering if you see such an effect, at least empirically. I was thinking if you have this increase in interest rate, this will have an effect on the value of the debt held by the private investors.
Yeah.
So that may have an impact on their collateral value, and so they have maybe lower investment. So here, maybe the composition of the debt holders might matter, whether it is domestic versus foreigners.
So it might have been studies we use microdata. There was a job market paper by Leclerc that tried to argue that the maturity and the valuation of how much that you own, whether you are hand to mouth, and so on, would matter for macro.
Yeah.
And there's been paper showing that the longer maturity of the debt and the duration of the asset you have, the stronger the valuation effect of monetary policy. Now, this could be driving the result here if we have the valuation effect tighten very much the collateral constraint of savers, and then they cut their consumption a lot. But what you would observe is that monetary policy is stronger when public debt is longer. And so basically, you need to think that we have 3 or 4 type of agents. Saver to all that, hand to mouth, and the government. And forget about the foreigner for 1 second. The hand to mouth are really crucial and they are not effective, but they are the one who are usually driving aggregate fluctuation. So my explanation of why we don't see valuation effect mattering that much is because valuation effects happen to the recurring agents who really don't move much. And the hand to mouth are insulated from valuation effect. That is why the heterogeneous agents type of argument I don't think is strongly at play here, also because it would go in the other way if it were.
Just a quick clarification question that's pretty much the same as my colleague here asked in the first presentation. Does this include debt that's held by the central bank?
Very important question. The baseline does not include, excludes debt that is held by the central bank. I do our best to see that it doesn't matter, but it is very important to take out anything that the central bank has because this is just an accounting thing.
And I assume mathematically, if you flip the shock, the negative should be equivalent on the other side. But when you say it's more responsive when you have longer duration debt, but long duration talking about 20, 30 years for US bond, but the economic cycle is much shorter than that. And they reflect on 5 years, which is the Fed mandate on recent monetary policy. So
let me understand. The question is it symmetric whether you are tightening or an easing?
Yeah.
I try to test it. I don't say differential effect by the triple international is a tightening or an easing. My explanation, well, there's 2 possible explanations. One is power. With a triple international times series, you lose all the power. So that is a very likely explanation. But there is also one other more structured explanation for that. Debt issued by the government is non-callable. This is different from mortgages, where you do see a very strong asymmetric response of tightening versus easing, because mortgages in the US, they are mainly callable, you can refinancing them, so they have a call option. For the government, you don't have that. If interest go up, you are happy. If you have long debt, if interest go down, you are unhappy. And it's exactly symmetric in that way, which is why that's why I think I don't see a differential effect of tightening versus easing. But it would be power.
You have one last question? Okay, thank you very much.
Thank you.
Now we're gonna switch gear, move away from local projections. One of the nice things about DebtCon is that we also have lawyers in the crowd. And so now we're gonna have Astrid Iversen, who's an associate professor of law at the BI Norwegian Business School. She's going to talk to us about economic crisis resolution and monetary power. Where's yours?
So it will be a little jump away from graphs, and I apologize if that makes it difficult to follow. It's mainly text here and talk, and that's how lawyers normally do storytelling. So we're going to focus on what is called sovereign immunity rules. And sovereign immunity is very basically, for the non-lawyers in the room, is rules prohibiting a foreign court to accept cases concerning another state. So Norway cannot be sued in the court of Sweden in certain questions concerning its state sovereignty. It cannot also not experience enforcement matters in a court, in a foreign court. So that's basically what sovereign immunity is. And in my paper, I'm discussing the different threshold of protection by the sovereign immunity rules when it comes to central bank policy measures and sovereign debt restructuring measures. So I'll try to simplify a lot, not only for the non-lawyers, but also because it's kind of an abstract comparison. So basically, in very simplified, states are actors in the markets in several settings. They are actors as regulators, but they also, and have for a long time, also been business actors. They've been doing businesses. And the distinctions between whether a state is regulating or doing business affect the applicability of several set of rules and legal frameworks. And sovereign immunity rules are one set of rules that are affected by whether we perceive the state to be doing business or acting as a regulator. And it also influence the extent to which creditors can attack central bank policy measures in a foreign court and can attack sovereign debt restructurings. So in my paper, I'm just looking at these two measures, and I'm broadly calling them economic crisis resolution or prevention measures. So it's a simplification. The goal is to examine the state's capacity to effectively prevent or solve economic and financial crisis. That's the overarching goal of it. And the question is, so I'm preempting the answer, why and how is the different level of protection justified? I'm looking specifically at the International Law Commission. It's a body connected to the UN that often drafts legislation on an international level. How have they justified a different level of immunity protection? I'm going to go very quickly 2 words about the prevention measures, which I'm sure you are well aware of, and then what is actually the level of protection that we have currently today, and then what kind of justification has been given for granting this different level of protection, and then structural factors limiting a state acting free choice to choose between what kind of crisis resolution measures they can use in a crisis, and then some concluding remarks. So even though it's a bit weird to have this presentation maybe and the lawyer in this panel, it makes for me at least very much sense, because the fiscal monetary interaction is very much something that is, I would argue, ignored by lawyers. And maybe also the limitations that the law sets up is maybe also ignored by economists. So the fact that the legal framework has a certain view of the fiscal monetary interaction is something that economists sometimes should take in as a factor, as a limiting factor of their findings. So that's something the lawyers and the economists should have in the back of their mind. So very simplified central bank policy measures in this crisis prevention resolution bubble. We all know what the objective of central banks current days are. The point in my presentation is that the issuing, selling, buying of financial assets, and particularly holding of foreign exchange reserve abroad, constitute a risk to the central bank's implementation of its policy measures. If suddenly Sweden is attacking Norwegian foreign exchange reserves and blocking them, or as we have seen, Russian central bank assets have been blocked, that makes it difficult to be a central bank and implement its measure. So the risk is enforcement against assets held abroad. When it comes to sovereign debt restructurings, we all know that there are no insolvency mechanisms. So we need to, a debtor state in trouble, need to renegotiate the debt contract with its creditors. The risk here is more associated to the lawsuit itself, because a lawsuit will prolong the negotiation. There's a risk of holdout, so it disturbs the whole process of trying to get back on the feet. And the sovereign immunity rules can hinder these risks to happen. We have, for example, sovereign debt restructuring. They could, we can imagine if the immunity, restructuring process as that will hinder creditors from attacking it in the debt restructuring process. The rules that we have today is that sovereign debt restructuring, at least sovereign debt issuances, are not immune. We know this by all the debt litigation that we have seen the past 20 years. When it comes to central bank property, the rules in international law and in domestic law is generally and simplified that central bank property is close to absolute immune. They cannot be attacked. The Russian and Venezuelan and Iranian attempts are freezing of assets, which is a slightly different discussion. But the point is that central bank property is basically impossible to attack in foreign courts. So they are a very different threshold for attacking central bank measures and debt restructuring measures, which both influences a state's capacity to have monetary and financial stability. So what are the justification for the very different level of protection First, I should say that the rules on sovereign immunity have developed vastly the past 50 years, somewhat simplified. So we've gone from something that we call absolute immunity to restricted immunity. So before the 1950s, no states were able to be sued in the courts of another court. But with time, this became a more liberal practice, and we are now having a doctrine, somewhat simplified, called restricted immunity. And the thought is that when a state enters into the market, it has to accept the rules of the marketplace. You cannot treat them differently. They have to be competitive, if not as unfair to the private actors. So if the state is in the market as if it was a private actor, it is no longer protected. That's the main thought. And then if you go dig deeper into the discussion, especially held in this UN body, the International Law Commission, who worked from the 70s until 2000 approximately and had a UN convention. If you see the discussions in this body of experts, representatives from different part of the world, especially when we look at the justification for protecting central bank property, again, simplified, there is a need to protect because of the central bank's role in its economy. It's the main justification, especially for a developing country who might rely more on foreign exchange reserves. But it's basically not a very advanced argument. It is its role in stabilizing the economy that has received the main focus. One of the quotes for this 20 years of negotiations. And I should also notice there is very little discussion about central bank independence. It's not granted special or extra absolute immunity because of its independent role. That does not come up. It is mentioned, or there is a discussion whether central bank should only have protection for its monetary policy associated property. This discussion dies out without any clear conclusion. So it looks like it's all the property, but this is a question that is still being debated. So it's just the general role in the economy and the role it has to destabilize the economy. That is justification for absolute immunity for property central banks. When it comes to protecting sovereign debt or debt renegotiations, there is not really any mention of it in the long year of discussion. It is even listed as a clear example of what constitutes a typical commercial activity of the state should be treated like any other commercial debt and commercial activity. And we've also seen, so the listing is the issuance of debt. And we've seen from case law developing since that also restructuring activity as such has been regarded as commercial activity and therefore not immune. Should we mention that the increase of litigation against states and their restructuring processes did not start in the 70s, but mainly after this UN convention was its final version of the draft was there. And we all know the disruptive potential of credit litigation for a restructuring process as such. And maybe you can only speculate if this had been a trend earlier on, maybe we have seen more discussion of the potential risky consequences of not having any immunity protection also for the debt restructuring process as such. So, of course, I'm showing that these have different level of protection for a reason. And when we see this, having a lawyer at least would maybe ask, but why don't all states just rely on central bank more sound monetary policies to avoid any sovereign debt problems? That would be the easy solution and maybe consider stop borrowing. Of course, it's not that easy. There's a need for understanding the interrelationship between restructuring, sovereign, sustainable lending, and central bank measures, as this panel also shows the clear interaction between the two policies. Also, it's very important to remember the more overarching structural factors that access to the central bank measures, and how efficient central bank measures in the times of crisis is also very unequal. So just one core influencing factor is, of course, the currency flows in times of crisis and rollover risk, which we will hear more on later, that certain countries have poor access to liquidity in times of crisis, which will make it much more likely for them to default and have a need to restructure. And of course, I'm not simplifying and saying this is the only factor causing a debt crisis, but there are certain structural factors that also influence that should be taken into account when you're discussing this monetary fiscal interaction. And yeah, some central banks struggle significantly more to contribute to secure them a sustainable debt, upholding its own amount of foreign exchange, etc. So what are my concluding remarks or solutions or thoughts around this dynamic and the fact that monetary policy is very well protected, sovereign debt restructuring is not? The overall picture we see is, of course, that the fourth country where we see currency flights in times of crisis are those protected the least because they have no, are not shielded by immunity at all. And if you look at the underlying justification for the legislation, at least in the international level, it's not really justifying the very different treatment, and it hasn't understood the interaction between monetary and fiscal policies. And this is bad for the way we discuss sovereign debt and with what kind of moral responsibility we put on states who end up in a sovereign debt crisis. The solution is, in my view, not to say that all sovereign debt restructuring should be protected by immunity or saying that we should remove immunity for central banks. But I think there is room for a more nuanced debate on to what extent should sovereign debt restructuring processes be shielded by immunity rules, by other rules. I think there is room, and this is the more nerdy debt, the law-specific debate of the paper, which I'm skipping here in this presentation, but there is both by court practice, there's room for distinguishing, for example, between the act of issuing the debt with, I think it's difficult to say that it is not commercial, but the act of restructuring it, that has more of a governmental nature to it. And therefore that process should be more protected. We see case law both in Italy and Greece that there is room, and also in England and Wales. And I think there is a need for an update among lawyers to see this interaction, and for the judges then to take that into account when looking at how they implement the rules. There is also good reasons for understanding these mechanisms when you try to implement new legislation. There is possibility to implement sovereign immunity legislation. We have examples in Belgium, England and Wales and France where they have specifically protected the debt restructuring, and this underlying argument could become a part of that justification. And last, it should also be a part of the justification for adopting other restructuring incentives. It could be contractual, domestic law, or even procedural facilitation. The previous panel we're discussing, for example, a stay on litigation during a debt restructuring process. So there are many possibilities to improve the incentives to kind of make the interaction between the two policy tools more coherent.
Yep. A couple of questions. Yes.
Just a minor clarification. Could you further explain what do you mean by individualizing method for these activities, please?
Yeah, that was a very niche. So in the rules of our sovereign immunity rules in several jurisdictions, you see either you say, for example, the issuing sovereign debt is a commercial activity, and I would say it's agreement across most jurisdictions of the world. But the later activity of restructuring is a separate action. And in some jurisdictions, I would say, maybe in Italy, but in England, they have a more loose approach. They don't say like once a trader, always a trader, like this maybe is the tendency in the US. And in some jurisdiction, there is more room to see that the court practice can distinguish between the different acts in a process. So that is individualizing the activity in itself.
There are questions? Yes, in the back.
Thanks very much. I very much agree with the setting. And I think there's a risk that I'm playing the old guy who knows everything better, but that's not my intention. My question is, we have to take into account each time we talk about the development of sovereign immunity rules, the context within which that takes place. And I think it's quite conspicuous and quite helpful as an explanation of these differences between money and so on, that if you look at what happened in the 1970s with this extension of international investment, capital liberalization is basically the justification. And maybe we can find similar, opposite.
Could you repeat the last part of it?
Sorry. So the point is just that we can, lawyers think as sovereign immunity rules as something that develops out of an intrinsic legal concept. And what we can see is that it really develops in step with the political economy. So sovereign immunity rules changed in the 1960s and 1970s when there was capital liberalization. Then all of a sudden the commercial exception appears. Yeah, and so on and so on. And Rollover happens just after the Baker and Brady bonds thing. Yeah, when it was really needed. Yeah, and so we really have to show or have to see and have to be aware how contingent law is, how dependent it is on major macroeconomic developments, and that would be just a political economy reason why your differentiated math solution is right way to go.
Can I just answer quickly? So I totally agree. And there's so many underlying factors. For example, the majority of case law that have developed since the early 2000s is in two jurisdictions, New York and City of London. And they have their own interest, which you can easily see reflected in the judgments. If you see the case law that has come to the European continent, they're mainly associated with the post-financial crisis, 2008 financial crisis. And there is a different approach, much less harsh. It's states within the euro, you need to protect the euro. And the reading is suddenly much more open for maybe also protection. While you're having defaulting Argentinian state sued in the court of New York, it's not so much understanding or willingness. So you see the political contingency in the development of the rules.
One last question.
Yeah, Monzon is my name, lawmaker from Germany, and thanks a lot for your paper. And I want to ask a question with regard to the solutions, because we're currently in Germany as well, discussing potential gates that we might have from national legislation in order to make debt restructuring systems more efficient and more just. Knowing that Germany and Frankfurt is not the place #1 for international bonds. But I was wondering, especially since you mentioned UK, Belgium, and France, if you can add more details on that. What do you be, and also looking at the current developments on the New York State Assembly, do you feel like they're going to the right direction in order to also address the problem that you have mentioned here? And if not, do you see any other points that could, make the situation more better?
So happy to continue afterwards as well with the discussion. So I think the specific legislation here is not to say that they are better than the one currently being developed in the UK or in New York. They were directly linked to immunity. And I think Germany, even though it's not the main fora where you list sovereign bonds, the same goes for Belgium and France, but sometimes you have a creditor purchasing bonds, and then that is the form for litigation. So I think it's also very important that Germany participates in that debate. And I think, yeah, a combination of immunity and contractual legislation, making incentives like they do in New York, are very important.
Thank you very much. So now we're gonna move to the last paper of the session by Paul Fontanier, who's an assistant professor at Yale University, and he's going to talk about sovereign bond purchases and rollover prices for those years.
Okay, so thanks a lot for the organizer and everyone for being here. I'm going to switch gears again, so from empirical economics to law to pure theory. So I know it's a bit late, so the challenge is that I'm going to do everything without any equation, and I hope it's going to be clear what's happening. So I want to talk about sovereign bond purchases, just to be clear. What I mean is sovereign bond purchases by the central bank. So this time we really want to talk about what happens when the central bank uses its balance sheet to buy the sovereign bond of the country, and the country I'm going to use as, you know, case in point for the whole presentation, but maybe we can find other examples that make sense. It's going to be Italy. Just keep Italy in mind as the case in point. Why is it that we see sometimes central bank actively buying sovereign bonds from countries like Italy? You look at the pure conventional theory that you find, for example, dating back from papers by Kern, is that there is the idea that it's a way to prevent self-fulfilling debt crisis. What is self-fulfilling debt crisis? Here it's a case where private investors are really afraid that the country is going to default, so they ask for an extremely high yield on the bonds to lend to this country. Of course, it's too expensive to refinance yourself to actually go into default, and that's the self-fulfilling default. Okay, so that's something you want to avoid. It's purely a loss in welfare to actually enter this equilibrium. And if the central bank stands ready to buy debt at a sufficiently high price, a sufficiently low interest rate, then there is no reason for investors to coordinate on that bad equilibrium when they would think that the country is going to default because of high interest rate, and so you just kill that bad equilibrium, it disappears. Then it also never happens, right? That's the interpretation that we have most of the time for the very famous Mario Draghi moment of whatever it takes, right? So the yields on Italian debt starts to spike up. Mario Draghi arrives and says, whatever it takes, we're going to do what's needed such that this kind of debt crisis does not happen, and then suddenly yields go back down. And the ECB actually does not have to buy any of these bonds, right? They just need to stand ready to buy these bonds, but they actually don't have to buy these bonds. If you look at what happens in 2015, this is not the same story, right? Why is that? Here, that's the graph of stock of the debt holdings of debt and debt. In red is ECB, in blue and gray is everyone else. You can see that since 2015, Italy basically issued around 700 maybe billions of debt in euros, and more than that amount was actually bought by the ECB. So they completely crowd out every other private investor, at least when it comes to duration. So we need a different theory for why that's happening. Okay, and we need a theory that's not only telling us like, oh, maybe we actually need to buy a little bit of bonds. We need a theory that tells us like sometimes we need to buy an incredibly large amount of bonds. And of course, that raises the second question, which is when you do this and you intervene in financial markets with such a huge scale, right, something that's never seen before, we might also want to think about the cost and perverse effects of such intervention. Okay, so usually sovereign debt markets are perfectly well-functioning private markets where investors gather, they acquire information about the fiscal soundness of the country, and they decide how much they're ready to lend to that country, and that creates incentives for countries to maybe behave in some fiscal way, to create incentives for private investors to monitor what the country is doing, and so on and so on. If suddenly you have such a huge player like the ECB that enters this market and buy more than 15% of the stock, then maybe that creates some problems on this incentive, and we might want to take them into account when we talk about how we should design such products. So what I'm going to do here, again, apologize, the pure theory, almost pure theory. I'm going to build a model that has, asset pricing features where investors, or actually, these things exist. So investors pick up a hedge fund, decide how much effort they want to put to try to understand what is the fiscal capacity of Italy going forward. What are the debt repaying capacity they have? Am I confident enough that they're not going to default? Okay, that's an effort that I should take, and that's cost a lot of money. there's going to be sovereign debt issuance with that kind of risk that I mentioned at the beginning, self-filling the crisis. Okay, and then we're going to study asset purchases by the central bank. If I just tell you this, you could say, okay, build a model where asset purchases maybe have a cost, but they also have benefits. There's going to be a trade-off, going to be between the two, and that's the end. That would be very boring, so I'm not going to do this, and I'm going to turn the argument on its head, and you're going to see how in a second. Okay. So again, I'm not going to do equations, so I'm trying to make everything with graph, but I just want to tell you what is the setup of the paper. Okay, so there is a timeline here that is ends here. Sorry about this. So what's the idea? There's a country again. It's Italy. Thank you. But there's nothing else. Thank you. There's a country like Italy that need to finance some expenditures. And to do that, they need to go on international markets to issue some bonds. Okay, it's going to be 3 periods. At first, they issue some bonds. Then you enter a new period, and they need to refinance some of these bonds. And that's where you can enter this rollover crisis problem. Okay, so it's going to be off the shelf. There's a very nice model from Nicolo if you're familiar with it, and then describe in a second what it is. But the idea is simply that here, if you have too much debt already to repay, you can enter this self-fulfilling debt crisis problem when investors think you're going to default, and you actually default because debt is fixed. Okay, that's happening here. The interesting question for me is what happened before. Okay, the country is still going to issue some debt. Investors know that this thing might happen in the future. So they take some, what we call in the literature, information acquisition. So they decide whether they want to invest or not in understanding the fiscal capacity, for example, of the country. But then also the central bank and investors take that into account. The central bank can decide to purchase some of these bonds, maybe a small amount, but a large amount, and you're going to see why that matters in the future. But what I want to show you in the paper is that this decision by the central bank is, of course, going to have some spillovers on information activity. So when you hear, and that happened at the panel at the BIS or at the Fed board recently, when you hear people like being concerned that these asset purchases are creating costs because it kills the price discovery process, that's what I'm trying to motivate here. Okay, the central bank buys a lot of bond, then suddenly the sovereign bond market is not going to be as transparent as it would be without central bank purchases. Is that a problem? I'm going to argue that it's in some circumstances it's not. So I need to keep again on the slide. Yes, thank you. So very quickly, but what is a rollover crisis in that mode? It's very simple. That's what happened in the intermediate period. So your country, you issued some debt. That's the B1 star number here. Okay, in the past, so that's given, and then you decide how much you want to issue again. When in blue, you have this very nice value function. You just want to maximize this. It's basically the country. If investors think you're not going to default, you get this functional form here. So you want to maximize welfare, you just issue here. So the problem is that if investors think you're going to default, you're not going to be able to refinance to issue new debt. Okay, so the question is, if investors think you're going to default, you're not going to issue some bonds, right? But you can still decide to repay the previous bonds, and you would be here. But the value of defaulting is here. So if that number here is above this one, you get into rollover crisis in the sense that if investors believe you're going to default, you're actually going to default. If investors believe you're not going to default, then you will be here and you're not going to. The thing here is simply to say that depending on how much debt you issue in the past, you might be above or below that mode. Okay, so the investors in the country all know that if you issue debt in the past, such that this is higher than some threshold number, then you can get into this problem. That's the dynamic idea of rollover crisis. I issued too much in the past. People think it's going to be too expensive for me to refinance. Then I get into default crisis. Okay, we can think of that's what happened for Italy, for example, around 2015, but also in 2000. Now, what happens with this information acquisition stuff I was mentioning before? That's the interesting part of the paper. So the intuition here is that if you take any type of assets, forget about sovereign bonds for a second, take a very normal type of asset, maybe equity or something like that. Usually, we like price discovery information acquisition. These things. That's why we complain about the fact that asset purchases are maybe bad for the included. What's happening here? In this graph, that's the price of the asset. Okay, and here on this axis is the amount of hedge funds, in my interpretation, that decide to actually pay cost and acquire information about your countries or about the asset. What's happening on average is that the price is going to be increasing with that share of agents, of hedge funds that decide to acquire information. The idea is that the more agents are informed, on average, they're more certain, they face less uncertainty on the repayment capacity, and so they're ready to buy debt at a higher price, or just to offer a lower yield on the debt. That's the good thing about information acquisition, right? More agents acquire information, everyone has less uncertainty, that's just good for the price of your bond. It's easy for you to refinance, to refinance. There is another side of information acquisition, which is that depending on the shock that happens, you might get also more volatility on the average price. Okay, so the average price is going to be increasing, but the volatility around here is going to be increasing. Okay, if you don't face default risk, then that's fine because volatility on average, but what matters for you is ex ante, what is going to be the average price, the average. The problem with sovereign debt can be subject to the self-fulfilling crisis I was mentioning before. When can you have such self-fulfilling crisis? When the amount of debt issued in the past was too high, which is the same thing as saying when the price on your debt in the past was too low. Yields and prices are inversely related. And so now you get into a different picture. Okay. You get into a different picture in the sense that suddenly, after some threshold, information acquisition or price discovery is not that attractive anymore, right? If a lot of hedge funds do their own research, as they say, about the fiscal repayment capacity of the country, then in the event that what they discover is bad news, you're going to be below the price threshold that creates this rollover price. Okay, so suddenly transparency is not so much of a good thing. And it's not a good thing for the country, but it's also not a good thing for investors because everyone wants to avoid this kind of rollover prices that are completely inefficient, right? And the reason you get this kind of thing is that if you don't face rollover risk, if you don't face runs, in a sense, then information acquisition is a good thing because volatility has no only a second order cost on the finance. But suddenly, what you care about in that type of event, where there is runs and self-fulfilling debt prices, is a lower bound on the prices of the debt, right? When what you care about is actually the lower bound and not the average price, then volatility matters a lot, and you want to avoid that kind of volatility on the sovereign debts. And what's one way to avoid this is to try to hamper price discovery, prevent the fact that this price discovery process is going to take place, which is exactly what you can do with asset purchases. So if you look at this here, you have the institution for the paper, which is from a country like Italy, and it happens that the equivalent around here, right? So a lot of hedge funds are like actively trying to understand repay or no. It's better for me if someone intervenes such that that threshold moves to the left. Okay? I'm going to have less information acquisition, so less price discovery if you want. And in average, we think that this is a bad thing, but for this specific type of asset, it's going to be a good thing. The average price is going to be higher, it's going to be easier to finance myself, and I'm going to avoid this kind of completely welfare destroying problem. So why are asset purchases working here? Again, it's a theory paper, so there's a theorem in paper, but that's fine. The idea is simply that if I reduce the number of bonds that are actively on the balance sheets of private investors, they're going to hold less risk. But the cost of actually acquiring the information about whether the country is going to repay or not is something that's fixed. It's a fixed cost, right? You need to pay for, Bloomberg terminal. That's a terrible example, but that's the idea the very simple idea that you can. Okay, so I'm going to hold less risk, but I still have to pay the same thing to acquire information. I'm going to be less likely to do it if the central bank is buying a lot of these bonds, and so the marginal investor is going to change. Okay, now just two key characteristics of this feature that I was mentioning at the beginning. This is not the not equivalent. This is not the Draghi story of the central bank says that they're going to intervene, so I don't acquire information. It's the central bank buys bonds, so I have less risk on my balance sheet, so I acquire this information, and so that's why I get less rollover prices. And then the second thing is that there is a minimum size required. Okay, if you're here, you don't need to buy just 1% of the bonds in circulation. You need to buy a lot of them to actually go to the left of that threshold. So that's one explanation for why the central bank, the balance sheet of the ECB is so inflated right now, because you really need to move that threshold. I have about 2 minutes. 2 minutes, perfect. So I told you it's a fully theoretical paper, but actually there is a very small empirical part just to check whether what I'm saying makes kind of sense in the case of the ECB and Italy. So one way to do this is you look at what analysts forecasts are doing before the asset purchases program and after the asset purchases program. Okay, so the key prediction of them all is that if you buy a lot of bonds, you're going to have less information acquisition, which in this model just means that the forecast that these analysts are doing is just going to be way worse than before. So you can look at the distortion of this forecast. And what do you see? After asset purchases, it's like twice what it was before asset purchases, even though the volatility of yields has been decreasing dramatically. Okay, so this is not driven by bad time versus good time. It's actually yields. Volatility of yields is lower, and the average quality of the information is actually much worse. Okay, so that seems to be broadly in line with the message of the paper. There is it's not a general market paper, but there is extensions. That's what we do in theory, right? A lot of different extensions. So I don't want to show you this graph because I don't have time. I just want to say, sorry, maybe one thing about this, because of course the next step in that kind of argument is that if I'm a country like Italy and I know that the central bank is basically going to buy 25% of my bonds to prevent this kind of costly information acquisition process, I'm going to take into account, I'm going to issue even more debt. If I do this, the ECB is going to have to be buying even more debt to prevent information acquisition. What happens in the end, where you end up in an equilibrium where you issue a lot of debt, the ECB buys an incredible amount of it, and there is basically no information incorporated into my bond. Okay, so the price of the Italian debt in that example is basically completely uninformative about the fiscal capacity, the capacity of repayment of the country, because no one makes any effort to try to understand what's going to happen in the future, since the ECB is buying so much. So I'm perfect. Thank you very much.
So we have time for questions. We started the session 5 minutes late, so we're gonna end at 5:15. So question from the audience. Yes.
So if your mechanism is about information acquisition, when you were showing the numbers here for the errors, basically, I thought maybe you could try to see the error relative to the ECB, to the error the ECB is making, for example. So you could think like you have private investors and you have the ECB making forecasts. And so if you can show that the private investors, they do have this huge increase, but it's not like it's much more than what the ECB has.
Very, yeah, I should definitely do that. It's a very good. So,
maybe it's not clear, but yeah.
No, I understand. I think we can talk more, but yes, that's a good point.
Yeah, on this, I mean, it became just hard to forecast everything after the, before even before
COVID is not there.
Even before COVID became much hard. But I wanted to ask you, can you back out how big the cost is?
So it's much harder to forecast, but at the same time, it's still not moving at all.
Yeah.
Right.
Yeah, but people expect that you are just going to go back to the. You just expect you're in this period. People expect to have inflation to go back very quickly to target, which didn't happen, and so there was a lot of expectation being reversed, which was bad for many.
Okay.
But can you quantify how big this information acquisition cost in percentage of GDP from this experiment?
You will need a model that's much more like quantitative and so on, but that's a good question. Yeah.
Because my prior would be that for corporate debt, where you need to send analysts, that is very costly. Like the information acquisition cost is probably very high for corporate debt. For a country that issued 2 trillion, more than 2 trillion euros, and all the data is public. The fixed cost I expect it to be low. So it would be nice to have a back of the envelope. How big would it be?
It's a good question. A small anecdote on this. I went to that project because my wife is a hedge fund analyst, and so that's exactly what they're trying to do.
Okay.
They take a country and they actually try to very hard to understand what's going to happen for inflation. And as you say, it's very hard to forecast, much more than earnings for a company. So I agree with the data is public.
Yeah.
But at the same time, the forecasting process, I think, is much harder for a country than for a company. We can debate that. In any case, it's a good one. What is the actual magnitude of these effects? And that's my question.
And the last thing I wanted to ask is, so when you have QE, the stock of that doesn't change. You are just changing the composition of that because you go from BTP and bonds to central bank reserves.
Yeah.
Can you comment a little bit on that? Is because bonds are special and the hedge fund manager only buys bonds, and that is why this composition of bonds versus the reserve matters, because the total quantity of that is fixed.
The total quantity of that is fixed, but the total quantity that is on the balance sheet of a private investor like a hedge fund is not. And so that's why you get these effects. And otherwise, this effect goes away. Right.
And this is because we are not looking at banks, but at other investors, because the banks then are the one holding the reserves.
Yes. Well, in any case, you need to look at an international investor, because if you look at the local one, they should take into account that the central bank is buying my debt. If they make losses on it, they're going to tax me, and so it's the same thing. That this relevance exists. So you need to break that first to get that kind of effect. So that's why I'm thinking of hedge funds.
Okay.
Does that make sense?
Yeah.
Yes.
Very interesting. So at some point in the business program has to come to an end. Do you have any way to observe what happens?
So yes, point that's it.
The purchase program, like the purchase program has to come to an end, so they have to basically keep back.
Yes. So here in the mall, everything is completely symmetric, right? You can think of it as, imagine you bought a lot of assets, a lot of Italian bonds, and so you're here, and suddenly you want to get rid of it. You need to sell it back to the market. You sell everything and you go back here, then you're kind of in trouble. So it's telling you maybe if you want to do QT or that example, you want to do it slowly because you don't want to move that threshold. But then the long-term answer is that you need to do something such that that threshold moves to the right, then be able to completely fully upload the surrender you own as a central bank. And that's more in the spirit of like structural reform for the country.
So
Does that make sense?
you don't have any, yes, of course, but you don't have any kind of factor in the data to check what, because of COVID, perhaps that's just.
Yeah, so what we could do, if we have more data, is that now that the ECB is actually lowering the share of debt they are buying, is it the case that the quality of information incorporated into sovereign markets is actually higher now than before? I think we need a little bit more data on that, but yes, that would be the idea. Yeah.
Any other question? Yeah. Yes, the front.
Jag kan förstå, eller du kan från Israelis from practitioner point of view, your conclusions may also. I think that mechanism is effectively what we're seeing. So I think your conclusions are on point. I think the two periods where forecasts, there were two unexpected stops. In that period, one was the COVID, which was the one, and the other one was the Russian-Ukraine war. So it might sense to my sense.
I actually
the first half of 2020.
I did it also 2015 to January 2020, and I get the second thing. But yes, yeah, definitely. At least for the forecast. Yeah. For yields, it goes in the opposite direction.
Yeah.
You should see them move more, and then but yes, definitely. It's in the data.
Anyone else? All right. Well, thank you very much, and enjoy the coffee break.